Hello, financial enthusiasts! Welcome back to our channel, where we reveal the secrets to financial success and building a solid foundation for a brighter future. In today's video, we'll look at one of today's most popular investing vehicles, exchange-traded funds or ETFs. ETFs have transformed the way individuals invest, providing a diverse and flexible approach to wealth accumulation. Understanding ETFs is critical for optimizing your investing potential, whether you're a seasoned investor or just starting out. But what exactly are ETFs? What are they and why have they become so popular in recent years? These are the questions we'll be answering in this video. An exchange-traded fund, or ETF, is a form of investment fund that works in the same way that a stock does. ETFs, like other funds, combine money from numerous investors and invest it in a wide range of assets, including stocks, bonds, and other securities. ETFs provide investors with diversity by dispersing the fund's resources among numerous securities, which helps to control risk. Furthermore, because ETF shares are traded on stock exchanges, they can be purchased and sold similarly to stocks. As a result, investors typically need to pay commissions and other associated fees when trading ETF shares. Similar to the existence of various types of mutual funds, there is also a diverse range of ETFs, each having its own specific goals and objectives. Certain ETFs allocate investments across a mix of stocks and bonds, while others aim to mirror the performance of specific stock indices such as the Dow Jones Industrial Average or S&P 500. There are also ETFs designed to track the performance of specific market sectors such as technology and pharmaceuticals. However, it's important to note that the level of diversification provided by different ETFs can vary. For instance, ETFs that have a narrower focus on specific sectors usually offer less diversification compared to those designed to replicate an entire index. To illustrate investing in an ETF, let's consider a scenario where an investor aims to make a diversified investment aligned with the performance of a prominent stock index like the S&P 500. After conducting research on different ETFs and identifying the one that aligns with their objective, the investor purchases shares of that ETF through their broker, just as they would with individual stocks. Upon acquiring shares, the investor now holds a stake in the underlying basket of investments of the fund, all achieved through a single ETF purchase. By investing in a single ETF instead of multiple individual securities, the investor can participate in a broad market exposure, thus saving time spent on extensive research and analysis. Now, how can an investor potentially generate a positive return from the ETF? Similar to stocks, an investor can earn a return from an ETF in two main ways: through an increase in the ETF's market price and through dividends. Generally, if the value of the underlying investments held by the ETF rises, the price of the ETF tends to increase as well. For example, if our hypothetical investor purchased an ETF at $40 and after a year it was selling for $50, they could potentially make a profit of $10 per share by selling their position. However, if the price of the ETF dropped, the investor would experience a loss if they sold their position at the lower price. As many ETFs are traded on stock exchanges, they can be bought and sold throughout the trading day. It's important to note that not all ETFs have high trading volumes, which can present challenges when attempting to execute orders and fill them in a timely manner. Now, let's compare this to mutual funds. Unlike ETFs, the majority of mutual funds are priced and traded only at the end of the trading day. In addition to changes in the fund's price, our investor has the potential to earn income if the ETF distributes dividends to its investors. Dividends represent a portion of the fund's earnings and capital gains that are paid out to the investors. However, it's important to note that not all ETFs pay dividends, as many reinvest the earnings back into the fund's holdings. To determine whether a fund pays dividends, one can examine its dividend yield, which indicates the amount paid out relative to the current market price of a share. ETFs possess other appealing characteristics as well. Unlike most mutual funds that require a substantial minimum investment, ETF investors can simply purchase a single share along with any applicable commissions and fees. Additionally, since most ETFs are passively managed, they typically have lower management fees compared to mutual funds. There is a diverse range of ETFs available that aim to replicate the performance of various assets such as corporate bonds, stocks from foreign countries, commodities, and even currencies, along with many other types of investments. Although these assets come with their own specific risks, the ETFs that track them provide investors with a convenient means to analyze and potentially discover opportunities across multiple markets. Do you want to learn more about ETFs and other investments? Stay tuned to Stock Market Catalyst for more interesting videos on various investment topics. Remember to subscribe and click the notification bell to get notified anytime we add new content. Thank you so much for watching, and see you in the next video.